Many investments you own in taxable accounts could actually be costing you hundreds of thousands of dollars over time because of what's called tax drag. All this means is that depending on the investments you own, they could be forcing you to pay significant taxes at the end of the year, which drag down your portfolio's returns significantly, especially over a long period of time. In fact, many of the investments that I'm about to discuss could easily add 1 to 2% of a tax drag to your portfolio, and if we look at a 20-year study using an average return of 7.5% per year, the difference could easily be hundreds of thousands of dollars, even up to a $665,000 difference. Which, before we get started, all I ask is that if you do find value from this video, that you consider hitting the like, subscribe, and notifications button for future content like this. With that said, to get straight to it, the first investment to avoid in taxable accounts is mutual funds, especially actively managed ones. If you didn't know, mutual funds are pretty much a way for you to invest into hundreds to thousands of different investments like stocks or bonds, all within one purchase. Now, I recently created an entire video on the tax structure between ETFs and mutual funds, which I'll have linked in the description below for you, but the biggest takeaway that you have to understand about mutual funds is that they are typically structured in a way where anytime the investments inside of the fund are sold, that will trigger a cash transaction on the underlying holdings, which is a taxable event, forcing every investor in the mutual fund to pay taxes on the capital gains, even if you held the fund and didn't even touch it yourself. All this means is that you're going to have less control over your taxes, and an example of this was just a few years ago when Vanguard created big tax bills for target date fund investors, triggering thousands of dollars in surprise tax bills where investors who own them in tax-advantaged accounts did not face the same tax consequences. Where if we look at ETFs, they are typically structured in a way when the investments in the fund need to be switched, rather than selling them for cash to buy a new investment, ETFs aim to make what's called an in-kind trade where shares are exchanged rather than sold, allowing a non-taxable event resulting in no capital gains to investors. But the biggest thing I want to get across here is that with mutual funds, especially the actively managed ones with high turnover rates, this means that the funds change the underlying positions often and that you are more likely to have capital gains triggered that are out of your control. And so a great example on what to avoid here within a taxable account is the Fidelity actively managed mutual fund with the ticker FMAGX that over the past 10 years has averaged a 12.07% annual return. The market alone has been great the past 10 years overall, and that sounds great until you realize that this fund would have triggered many capital gains throughout the years by selling underlying holdings that you didn't even have control of. And if we look solely at the year of 2023 through Morningstar, you can see a small amount was income, that was the dividends distributed to investors, but also that both short and long-term capital gains were triggered. So let's assume an investor held this fund throughout the entire year of 2023. That means that the total distributions would have come out to be roughly $1.44. And if we divide that by the average net asset value, which is the price that mutual funds trade at, the average for 2023 was $11.18, which results in a 12.9% enforced income toward your taxes, even though you didn't realize any capital gains yourself. Which I'll also mention, if you want to check out Morningstar Investor, where you can see a lot of data like stock ratings, screening tools, and other features, I'll have a link in the description below where you can get a free trial and save $50 on your first year. But as far as that investment, let's say that you had $100,000 in FMAGX throughout the year of 2023, you would have added $12,900 towards your taxable income. Now, if we look back, the majority was at least long-term capital gains, which means you'd be taxed at either 0, 15, or 20%, depending on your tax bracket, but that's still a heavy tax burden that no one wants to have on them. But let's just keep things simple and say that everything is going to be taxed at 15%. That means that on the forced income, you would have to pay close to $2,000 in taxes, which means that on a $100,000 investment, your total annual return would be impacted by 1.93%. And not just that, but actively managed mutual funds also have much higher expenses than a simple index fund, where for FMAGX, the cost is 0.47% annually. So with that on top, you can nearly be losing out on 2.5% of your entire portfolio's return every single year. Realize that this difference throughout the time of your investing career can add up significantly, and if we assume that you were to invest $1,000 per month into a simple, cheap index fund that I'll cover shortly, if you do this for 30 years, averaging a 10% after-tax return, that means that you could end with a portfolio worth over $2 million. Where if you buy an actively managed mutual fund like FMEGX in a taxable account, the tax reg would bring your end portfolio to a final value of just under $1.3 million. That's over a $700,000 difference because of the investments that you choose, and because of that alone, it's well worth hitting the like and subscribe button. But on a real note, it is actually why one of the wisest investors of all time, Warren Buffett, suggests that for the majority of people, the best thing to do is buy 90% in an S&P 500 index fund. Now, if you are one looking to invest into an actively managed fund in a taxable account, ETFs will be much better for you, and if we look at the ETF comparison with the ticker FMEG, you can see that over the past few years, it has never triggered short or long-term capital gains to investors. And so to sum it up, the total distributions here would have been 8 cents divided by the average NAV of roughly $22. That means that only 0.37% of the investment would have forced income rather than 12.9% with the mutual fund version. Now, if you are in the decision-making process of buying an index ETF or an index mutual fund in a taxable account, understand that there are many index mutual funds that trigger capital gains, but the impact is typically much lower than active ones. So if we look solely at Fidelity's S&P 500 mutual fund FXAIX, it has actually not caused any additional short or long-term capital gains to investors over the past few years. But an example like Fidelity's midcap FSMDX, it has distributed some in the past few years. So the impact from index mutual funds is typically really small when it comes to the difference with ETFs in taxable accounts, but if you have the choice, you would ideally want to avoid mutual funds, especially the actively managed one. That is, at least if you want to have the safer approach to reduce additional tax drag on your investments in a taxable account that are more in your control. Which I will say, if you already own index mutual funds in taxable accounts, if you have significant gains, it's typically not going to be worth making the switch and triggering the taxes. Knowing that, let's now move on to the next investment to avoid in taxable accounts, that is taxable bonds. Now, besides short-term savings, if you have a long-term investment portfolio in a taxable account and you don't plan to touch the funds for quite some time, you'll really want to avoid bonds, and if anything, you would want to consider using them in tax-advantaged accounts like an IRA or 401k as you transition into retirement. And so something important here to understand is called asset location, which is basically understanding where you are placing your investments, because you would ideally want the most tax-efficient investments in taxable accounts, and if any, the poor tax-efficient investments to go toward the tax-advantaged accounts. So ideal investments for taxable accounts would be small and large cap stocks because they are low income producing investments, where one you would definitely want to avoid is high yield and global bonds. And so the reason I say to avoid many types of bonds and bond funds in taxable accounts is because the interest you're going to earn is going to be taxed at your ordinary income rate. This means that the income you would earn would be taxed in the range of 10 to 37% depending on your tax bracket, which is going to be a huge tax drag for your investments over time. In fact, if we look at Vanguard's bond ETF with the ticker BND, over the past 10 years, it has averaged a 1.45% return for investors, which at least reduces volatility for those in need. But the biggest reason to avoid it, especially in taxable accounts, is because the fund pays out the interest payments monthly, distributing ordinary income to investors, and has averaged around a 4% yield recently. Now, something really important to understand here is that Vanguard specifically shows that if you are in the highest income bracket, excluding state and local taxes, that your after-tax returns would barely be above 0%. So if you owned BND over the past 10 years in a taxable account, you may have barely even made money. Of course, everyone's situation is different, and if you are in need of bonds in taxable accounts, you may definitely want to consider it for only the short term, but if you are looking for long-term investments in taxable accounts, to consider more of the tax-efficient options like municipal bonds to avoid federal income tax, and in some cases, state and local income tax, or U.S. Treasuries that allow you to avoid state and local income tax. But knowing that, the number 3 investment to avoid in taxable accounts is REITs. Now, REITs stands for Real Estate Investment Trusts, which are companies that own, and in most cases operate, income-producing real estate or related assets required to invest in real assets and derive the majority of their income from real estate activities, including rents from properties and interest from the mortgage. Where 90% of REITs' annual income must be paid in dividends, and keep in mind the dividends received from REIT holdings are also taxed as regular income. So a very known REIT is Realty Income with the ticker of O that currently has a total yield of 5.43%. And if you aren't personally invested in your own real estate, this can be an easy way for you to gain exposure to a strong market without needing the significant time, energy, and personal risk of getting into your own properties. But because of the high dividend in taxable accounts, this would force a lot of taxes to you that are out of your control, and is why they would be best to use in tax-advantaged accounts, especially as you transition into retirement and are looking for a dividend income later on. And so while I mentioned that, something I really want to get the point across of, at least for me personally, as I'm young and still have many years until retirement, the way that I approach my retirement accounts like the Roth IRA is that I solely invest for growth with the idea in mind that as I near retirement, I will then transition to more safe income-producing investments that I could then use once I'm at the eligible age. I recently made an entire video on this, with the main reason being that throughout the years, you're not going to be touching the funds. And then once you're at retirement, everything in that account is going to be completely tax-free, so why not go for growth now and dividends later? Which, keep in mind, no matter what investments that you choose for the income, it can be completely tax-free, with the goal of starting now and building it up significantly so that you can live off of that income the rest of your life and not have to even sell any of the investments. But with that said, the next investment to avoid in taxable accounts is high dividend stocks. Now, dividend paying companies are known to be safer and less volatile overall than growth companies, but that's also because they use some of their profits to thank investors for investing in them, where growth companies tend to use their dividends to reinvest back into the company for future growth. Of course, it's a personal choice on how you invest, because many prefer to have the feeling of a dividend income always coming in, with the ability to live off of that before the retirement age with a 401k or IRA. But understand that especially if you are young wanting to compound your investments, that high dividend paying stocks can actually cause a significant tax drag on your investments throughout the years. And so one thing specifically that you really want to avoid in taxable accounts are the dividend stocks that pay out ordinary dividends rather than qualified dividends. Funds like JPI currently have a trailing 12-month dividend yield of 7.5%, and this fund specifically is able to produce the income because of hedging strategies. That alone is why the income with an investment like that would trigger ordinary dividends to investors, which could lead you to a huge tax burden on your future growth. Where if you instead invested into a growth index fund like Charles Schwab's SCHG that has a dividend yield of 0.5%, and all the dividends can become qualified, that means that the dividends here would be taxed in the long-term capital gains bracket of 0, 15, or 20%, and the dividends would be very low compared to a high income producing investment. It all depends on your goals and personal position, but if you are looking to grow your investments over time, reducing the dividends will help reduce the tax drag you have on your portfolio over time, which would allow you to have much better after-tax returns throughout the years. Like I said, if you are personally looking to live off of dividends before the standard retirement age, to consider building into them over time and focus on the qualified dividends. Knowing that, the next investment to avoid in taxable accounts is multi-asset funds. This consists of investments like target date and balance funds, which usually hold a combination of stocks and bonds. This would be great for retirement accounts, but in taxable accounts, they are not optimal as far as tax efficiency, and the income, especially coming from the bonds, will continue to have a significant impact on your after-tax returns. Not just that, but because of the constant rebalancing, if you are one thinking to invest into funds like this in a taxable account, you would for sure want to go with ETFs rather than mutual fund versions, especially after seeing Vanguard's target date fund investors who were triggered thousands of dollars in surprise tax bills because they own them in taxable accounts. But as a whole, when it comes to multi-asset funds, although there are some that aim for tax efficiency, if you are looking to reduce as much tax drag as possible for optimal after-tax returns on your investments, you would ideally want to avoid them in taxable accounts. So to just sum up the type of investments you would ideally want to avoid in taxable accounts, here's a great image to remember, as it shows balanced funds, bond funds, active stock funds, and REITs that are among the biggest ones you'll want to avoid. And remember that when it comes to investing into taxable accounts, because you are going to be taxed, you want the most tax efficient investments that you can get, and if you do want to use the less tax efficient options, to ideally try and keep them in tax advantaged accounts, where these ones would be much better suited for that. Knowing that, the last investment to avoid in taxable accounts is stocks you hold less than 1 year. As you probably noticed, a large focus to this entire video is about avoiding or at least reducing the investments that trigger especially ordinary income tax, and selling stocks within a year of owning them for a gain would also do that. For example, let's just say that you bought $10,000 of Apple stock, and after 11 months, the stock doubled in value to $20,000, and then you decided to sell it. Now, the amount that you would owe depends on your personal position and other potential losses, but if we just exclude that and assume that you take the 2025 standard deduction of $30,000, assuming that you were married filing jointly, if you stayed under $126,000 income that includes the $10,000 profit from the sale, then you would be taxed in the 10 to 12% bracket, which could cost you between $1,000 to $1,200 in taxes. But if you instead waited to sell the investment until just after a full year, let's say 13 months after buying it, with the same scenario, you would instead be taxed at the long-term capital gains bracket of 0%, meaning that you would not have to pay any taxes on the gains. Which, of course, the more short-term gains that you have in comparison to long-term, the more taxes that you will have to pay, and is why I highly recommend every investment that you purchase to view it as a long-term investment. You never know what could happen in the market, and with the right investments over time, they could do extremely well for you. The biggest investing lesson that I've learned so far in my life is that trying to time and pick the right stocks to outbeat the market is among the hardest thing to do successfully, especially across an entire portfolio. In fact, a quote from one of my favorite investors that really stuck to me was from Ray Dalio when he said, "Trying to time the stock market is harder than competing in the Olympics." Not just is it extremely difficult, but if you trade stocks within a year of owning them, you'll also have to pay much more taxes, which affects your after-tax return significantly. All in all, the best approach that I recommend for taxable accounts is the simplest yet most boring thing that you can think of, that is narrowing down your options to the best equity index funds like the S&P 500 or other growth-oriented stocks, and to just continue buying it over time and go on with the rest of your life. Now, if you are interested to start investing on a new platform or check out other financial products, I'll have a direct link to some of my favorite ones for you, which, depending on the ones that you get started with, I may earn a commission for it, which is greatly appreciated. End of the day, I want you to do what's best for yourself to improve your finances, but also know that I created many free learning guides like how to build an investment portfolio that I think you may find great value from, which I'll also have linked in the description as well. Which, if you also want to see how I allocate each of my investments and other exclusive content, to consider checking out the Patreon I have linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.